Silicon Valley Bank folded on March 10th, making it the second largest bank failure in U.S. history. On March 12th, three American federal agencies, the Department of the Treasury, the Federal Reserve, and the Federal Deposit Insurance Corporation, took urgent action, issuing a joint statement that depositors will have access to all of their money starting Monday, March 13th. No losses associated with the resolution of Silicon Valley Bank will be borne by the taxpayer. Unlike the 2008 financial tsunami, the subprime crisis didn't directly affect Chinese financial institutions at the time because of China's semi-closed financial market. SVB, however, has left some Chinese companies and tycoons with losses, especially for Chinese internet startups, which has undoubtedly added insult to injury. According to the Federal Reserve, SVB was the 16th largest bank in the U.S. as of December 31, 2022, with assets of about US $209 billion. Founded in 1983 in the U.S., SVB was once considered the gold funder and lifeline for startups. At a time when the high-tech industry in Silicon Valley was growing at a rapid pace, it quickly developed a flexible path by raising capital at low interest rates and targeting small and medium-sized enterprises that weren't yet valued by the big banks, successfully providing assistance to star companies such as Facebook and Twitter. China's venture capital industry has deep ties to the U.S. For China, SVB was far from being an ordinary foreign bank. SVB's business was built on supporting technology startups, and that included those from China. The bank had also set the Chinese market as one of its biggest opportunities for the future over the years. In 2010, then CEO Ken Wilcox brought the entire board of directors to China for a board meeting to show how important China was. It was the first time that the group held a board meeting overseas. The Chinese government reciprocated by approving the establishment of SVB, the first non-Chinese-led joint venture bank in China with an independent legal personality, in 2012. Bloomberg reported that on the night of March 9th, the night before SVB collapsed, executives at an investment firm that had backed ByteDance were glued to their screens in Beijing, monitoring SVB's stock price and news headlines before deciding overnight to pull their money out of the bank. Chinese media reported that a Chinese medical startup entrepreneur, Andy, a pseudonym, posted to his circle of friends on WeChat in the middle of the day on March 11th. "I didn't expect to wake up in time for the bank's collapse. My life is complete." Most of his company's dollar-denominated assets were in SVB, mainly used for payroll for U.S. office staff. Since the collapse of SVB, at least 16 companies in China, mostly biotech companies, have issued statements claiming that their exposure is negligible or that all deposits with SVB have been withdrawn so as to appease investors or customers. Meanwhile, the partners of these Chinese tech startups are helping them look for alternatives, transferring their money to new U.S. bank accounts, a process that is expected to take several months. Listed companies have large assets and rarely deposit their working capital in a bank, but for more small and medium startups, they usually only open a bank account. SVB worked with nearly half of all U.S. venture-backed technology and healthcare companies before it was taken over by the government. BeiGene, one of China's largest cancer-focused drug companies, said it had more than $175 million in uninsured cash on deposit at SVB, accounting for about 3.9% of its cash equivalents, and short-term investments. The company said recent developments at SVB don't expect to have a significant impact on the operations. Since the collapse of SVB, many other Chinese companies have publicly reassured investors. To calm public anxiety, some non-Silicon Bank customers in China have also come forward to explain that they have no deposits with SVB. The popular selfie app Meituan Incorporated said the company hasn't held any bank accounts with SVB since 2020. A statement was issued to avoid any potential public misunderstanding. It's unclear how many Chinese companies have SVB accounts. Given that Chinese public companies and non-public entities aren't obliged to disclose their risk exposures, they have the option of not disclosing anything at all. The fact that companies have chosen to make the announcement is thought that in terms of the overall exposure of Chinese companies to SVB, what we have seen is most likely to be just the tip of the iceberg. Before the U.S. government stepped in to bail out SVB, news of the collapse quickly appeared prominently in major Chinese media outlets and continued to make its way onto Weibo's hot search. Many wumao, the paid internet commentators, and Little Pink, the CCP brainwashed patriots, cheered over the chairman of SOHO China, Shiyi, and his wife, founder of Meituan, as well as Chinese venture capital firms, getting caught in the SVB mire. A Weibo account backed by the CCP authorities posted an article saying that Shiyi was rumored to have sold as much as 30 billion yuan in assets in recent years, buying some foreign properties and depositing more in SVB. SVB currently gives depositors a maximum payout of only 250,000 or more than 1.7 million yuan. Assuming he has 17 billion yuan of money deposited, that means a 1,000-fold shrinkage of assets. Shiyi, chairman of SOHO China, issued a Weibo post on the 12th to dispel the rumors. "We have never opened an account at SVB and have never deposited any money. Thank you all for your concern." Pan's Weibo IP address currently reads USA. The wumao and Little Pinks gloating over Chinese entrepreneurs have also raised the eyebrows of many sensible Chinese netizens. One individual commented, "SVB went bankrupt overnight, hitting technology venture capital funds and entrepreneurs, including Chinese high-tech entrepreneurs such as Ctrip, Ali, Sina, Meituan, Douyin, Xiaomi. A large number of Chinese high-tech companies, all of which got funding from US venture capitalists to start their businesses. That was how they got to where they are today, and that was how we get to enjoy the wonderful technology everywhere in our lives and the convenience of life. And so far, we also have a lot of venture capital companies' funds deposited in the US. Even bullish companies such as Huawei and BYD, which also have R&D centers in Silicon Valley, have funds in US banks as well." Here, we briefly explore the causes of the SVB collapse and the differences between it and the Village Bank collapse in China. Currently, the overall financial environment in the world is relatively fragile, with the risk of high volatility. Essentially, the failure of SVB wasn't due to losses, but rather a lack of liquidity. By the time the global pandemic of COVID hits in 2020, people were trapped in their homes and the reliance on technology had increased dramatically. So, in 2020 and 2021, there was a mad rush of capital into tech companies that were the main depository customers of SVB. This caused SVB's deposits to rise steeply from 61.8 billion in 2019 to 182.9 billion in 2021, a roughly threefold increase in 3 years. SVB then made the fatal mistake of using these deposits to purchase a large amount of long-term US Treasury bonds. The higher the bank rate, the more prices of bonds fell. The Federal Reserve began raising interest rates last year to curb inflation. The rise in interest rates eroded the value of SVB's bond holdings, posting a big loss on its books and denting the confidence of its customers. At the same time, bank interest rate hikes caused tech startups to have trouble raising money in later rounds and needed to draw on deposits. That is, startups were burning through cash faster than banks expected, and new investments had stalled, meaning no new money was coming into the bank. As a result, the bank's stock fell, triggering a run on deposits after announcing a huge loss on its bond holdings and its plan to shore up its balance sheet. Eventually, the technology-focused lender was shut down by the federal agency after plans to raise new capital failed. This is different from the bad debt problem in China's banking sector. The Federal Reserve and the US Treasury took emergency action to give depositors of SVB a full deposit guarantee, saving the depositors, not the bank. The depositors transfer their money to other banks. The depositors don't suffer losses. It won't affect the overall spending power of the society, and it won't result in many people losing their jobs.
I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again, and to protect American jobs and small businesses.
In the face of a bank meltdown, the Chinese government bails out the banks, not the depositors, because the depositors are the leaks that are used to being cut by the CCP. This is the major difference between the SVBs and the current banking crisis in China. Compared to SVB, the village banks in China's Henan province are much smaller in scale. Since June 2022, when the village banks broke up, until today, depositors are still being monitored closely and policed. This is the first day of 2023. Depositors shouted the slogan, "Henan Bank, return my deposit," and marched on the highway. The collapse of the US banks has made little pinks happy. What they don't realize is that when the same thing happens to the Chinese banks, they will face the result of losing all their money. So, what made SVB so attractive to Chinese startups? In the late 1990s, when China was still new to venture capital, SVB was one of the first financial institutions to start serving Chinese startups that traditional, risk-averse banks shunned. U.S. financial website CNBC reports that according to one Chinese tech startup founder, they once had tens of millions of dollars in SVB. He has since moved most of the money out, but he said he still had more than $250,000 in SVB. The source elaborated on what made SVB attractive to Chinese startups. He said the online system for opening an account at SVB allowed for verification using a Chinese cell phone number. With the backing of the mainstream venture capitalist, a startup could open an account at SVB within a week. He said, "Mainstream traditional banks like Standard Chartered, HSBC, and Citi have strict rules, and it takes a long time to open a bank account with them. It can take 3 to 6 months." The source, who founded a fintech company and 2 other tech companies, added that venture capitalists like working with SVB because the bank allowed investors to see and approve how startups use their money. No other banks offers these 2 features, opening accounts quickly for startups and letting venture capitalists see how their investment money is spent. Many Chinese startups that receive U.S. venture capital funding often open bank accounts at SVB from the start. By opening a bank account at SVB, Chinese startups can access capital from U.S. investors with the intent of going public in the U.S. U.S. regulators have said that all deposits at SVB will be protected. The federal agency, Federal Deposit Insurance Corporation, which took over the bank, appointed a new chief executive officer to run it. He told customers that the bank was operating as usual and that previously interrupted international transfers would resume within a few days. But the collapse of SVB has shaken investors' confidence. Chinese startups and venture capital firms say they still want to move money out of SVB when they can, according to multiple media reports. The Information, a Silicon Valley technology news outlet, said in a March 14th article that since March 10th, many Chinese startups have been contacting multinational banks to ask how long it would take to open new accounts. Executives at a U.S. bank in Hong Kong said their compliance team is overcrowded due to the overwhelming demand, which could lead to further delays in processing new account applications. Because of Communist Party regulatory restrictions on foreign ownership, Chinese technology startups raising money in the U.S. are often required to incorporate in the Cayman Islands and raise funds through VIE structure, which is subject to U.S. anti-money laundering and other regulations. It has made the process of opening bank accounts for these companies in the U.S. more complicated and time-consuming. The same reasons lead to the need for Chinese companies to go through another set of previous procedures when they move from SVB to a new bank. An executive at a large Chinese investment bank told Reuters, "Pulling out is the easiest option. No U.S. banker can offer the same service as SVB." The investment bank's private equity arm has deposited at SVB. He added that their bank's priority now is to have at least a few accounts in the U.S. A handful of Chinese lenders such as China Merchants Bank and Industrial and Commercial Bank of China are rushing to compete for the niche market left by SVB. These banks have offered account services similar to Silicon Valley's in the past few years, but they have found it difficult to crack the dominance of American banks among Chinese startups. The joint venture SPD-SVB is 50-50 owned by SVB and its Chinese partner Shanghai Pudong Development Bank. SPD-SVB said on March 11th that its operations were solid.
And this bank is an independent entity, independent bank. The only relationship, technically speaking, is the Silicon Valley has 50% share in this joint venture, but that's all. So as the SVB event unfolds, a lot of drama will happen in Silicon Valley, but it's not going to affect the operation of this joint venture in China.
According to corporate database SkyEye, SVB's parent company, SVB Financial Group, also owns 2 business consulting firms and 1 financial services company in mainland China. Trusted by the Chinese government, SVB also managed 2 government funds entrusted to it by a district in Shanghai. The collapse of SVB has arguably hit Chinese companies the hardest in terms of technology startups. From Baidu to Tencent, Chinese tech startups have been inextricably linked to U.S. venture capital for decades. In the past few years, Communist Party regulators have clamped down on the internet industry, making it difficult to raise capital and go public. At the same time, U.S.-China relations have been cooling, and the SVB bankruptcy could cause Chinese companies to slow down even more and business relations to cool even further. Taken together, it can be said that the golden age of Chinese internet companies' expansion has come to an end.